Okay, Chapter 16, Statement of Cash Flows. The FASB obviously requires a variety of financial statements, and the cash flow statement was the last statement. It's only maybe, I don't know, maybe 30 years old since they required it. And there's many reasons why. A lot of times profits is managed, and they might manage those profits down or away for tax purposes and so forth. And the balance sheet can be somewhat managed, so forth, but not cash. Cash is cash. And so it gives a much greater insight of what's going on inside of a company. And so hence now it is a standard statement required in the annual as well as quarterly financial statements. And the purpose of the statement of cash flow is how does a company obtain its cash? And where does it spend its cash? And it explains the changes in the cash balance. So it gets into detail because cash is not something that can be managed to hit a certain number. It is what it is. All right, importance of cash flows. How did the business fund its operations? I mean, the best point is a company that's growing from operations, not having to fund it from borrowing or selling stock. Does it pay dividends as an example? I mean, a company that's paying dividends or generates a lot of cash, there's a term in business called it's a cash cow. And that's a very, very valuable business because ultimately in finance, everything's related to cash flow. Again, cash is king, cash is queen, cash is everything in between. So it is the essence of business here. And another thing they also look for in cash flows is, does the business have sufficient cash to pay its debts as they mature? And I literally have seen companies grow themselves to death because they did not manage their cash flow. Their other assets were growing so fast, like accounts receivable and maybe inventory, they didn't have the cash to pay their vendors or even their employees. And then again, it goes into, are they borrowing, are they funding it from operations or from loans and so forth. So cash flow is a very insightful statement here. A couple key terms. Cash equivalents, an important term. Short-term, highly liquid investments. It's readily convertible into cash. And it's sufficiently close to maturity so that the market value is going to be unaffected by interest rate changes. Typically, anything that can be converted to cash literally within a few days. They say 3 months, but it's literally within a few days. This is things like CFOs will invest in like money market accounts or short-term certificate of deposits, treasury bills, 3 months or less, and so forth. And so any changes in interest rates is not going to affect that because the maturity date is so close. Classification of a cash flow. A cash flow statement will have 3 sections: operating, investing, and financing. So let's look at all 3 of these. Operating activities. This is the operations from the business, i.e. from customers' cash sales, maybe collections from accounts receivable sales, anything that's coming from the business activity. Borrowing for interest, cash dividends received, any outflows, paying your suppliers, your employees, interest on loans to charities. So it's really measuring the operations of the business itself. And this is actually the most, well, I don't want to say it's more important than the other 2, but generally you want to see that the business is generating cash flow from operations, and that becomes a more valuable company. Investing, this is like selling investments in securities. You might have bought some stock or bonds from other companies and so forth. Maybe collecting on loans, selling long-term assets like real estate and equipment and those kind of things. And then there's financing activities. This is maybe contributions in cash by owners, maybe selling more equity stock, or maybe issuing long-term debt. And a lot of startups, obviously, their business is coming from financing activities. They don't have an operations yet. But this tells the creditors and the other investors, what is going on with this company and how it's paying its bills, basically. So all 3 are very important. You are going to have to learn these different ways here to be able to calculate the cash flow statement. Understand that the cash flow statement, there are a lot of times some non-cash events that also have to be reported. Maybe retirement of debt by issuing equity stocks. So you might have had a convertible loan or a convertible note of some sort, and maybe that borrower, that issuer of that debt then went ahead and converted to stock. So that cash was done a long time ago when you borrowed the money, but now you're changing it from a liability to an equity section. You have to footnote that, but there was no cash being that transacted to this specific transaction, yet it's a significant event that needs to be disclosed. Same thing with conversion of preferred stock to common stock. Again, it does change the equity component of the balance sheet and so forth. Maybe leases, purchase of long-term assets, maybe by issuing a note or a bond, and maybe there was no cash transacted on this stuff. So there can be a variety of non-cash transactions that still should be footnoted in the cash flow statement here. The format of the statement of cash flows, you'll notice the three things, starting from operations, from investing, and from financing, and then you end up with your net decrease in cash, cash equivalents, and so forth. So you are going to separate all three in the cash flow statement here. And then they'll have a note of disclosure of some non-cash investing or financing transactions. Preparing. There's actually two ways to prepare a financial statement, so you're going to learn both ways here. But basically, you want to set up, step one, compute the net increase or decrease in cash. Or you go out and physically, if necessary, count the cash in the till and in your variety of bank accounts and so forth. Then you got to compute, how that cash came about from operating, from investing, and then financing, and then you want to prove and report. So you want to calculate, does this actually match up? Analyzing the cash account. So this is obviously where you're going to start. And again, there can be a variety of payments that are coming in, receipts coming in, as well as payments. You're going to have to separate that out and put them in as different classifications of either operations, investing, or financing activities here. And here's an example, for instance, how the cash was generated, was used in the operating activities. They paid for merchandising and maybe for operating expenses and so forth, and then investing, and then here's your financing activities. So this is what it will look for. A couple key points, the title, the statement of cash flow, and notice it's for the year ended. It will give a time frame. This is for the year and as of what date. Important component here. Non-cash account is looking at these changes in non-cash and then adding and subtracting those things. So let's look at this. Information to prepare statement of cash flows usually comes from three sources: comparative balance sheets, your current income statement. There can be other additional information that you might pull from bank statements, brokerage statements, that kind of thing. So, cash flows from operations. There's an indirect and direct method of reporting. I'm actually not a real big stickler of memorizing this, and the reason why is that today the software does this automatically, and you can tell it which way to do. The FASB recommends one way, but it does give companies the choices. So you are going to have to learn it manually here in this class, but I'm not going to spend a great amount of time maybe in testing the indirect versus the direct method. I want you to learn the basics of the cash flow statement, the three sections and so forth. But let's go into these two different methods, the indirect and the direct. And again, we'll go into greater detail here. So the direct method, let me give an example. Cash received from customers, paid out. This is in the indirect. So you're starting from the operating activities in the direct method, and you're going down, and then you will list it for the investing and then the financing, whereas indirect starts with net income. It starts from the income statement, and then you adjust each of the variety of accounts. Did it take cash? Did it add cash, like here, and so forth? So it's two different methods, but both methods should come down to the same numbers in the operating investing, and financing, and total sections. So there should be no difference in cash here. Again, they're just going to go, I think this is better read than explained, but you're just going to go into it. You've taken the information from the balance sheet and from the income statement and do this. I'll be honest with you, again, the software and spreadsheets now do this automatically. I am going to stop here and then we'll continue on with video number 2.